Good day and welcome to the conference call for analysts and investors for post-results discussion for quarter and financial year ended 31st March 2022 of the Anup Engineering Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rishi Roop Kapoor. Thank you, and over to you, sir.
Thank you, and good evening to everyone who has joined this call. Before I begin, let me share with you that I have here with me our CFO, Bhavesh Shah, and Company Secretary, Mr. Chintan Patel. We are officially joining today for our con call for FY 2022. Before we proceed to the call, let me remind you that the discussion may contain certain forward-looking statements that may involve known or unknown risks, uncertainties, and other factors. It must be viewed in conjunction with our business risk that would cause actual results, performance, or achievements to differ significantly from what has been expressed or implied in such forward-looking statements. Please note that we have uploaded the results, the press release, and also the outcome of the board meetings on the stock exchanges. And in case you have not received the same, you can write to us and we would be happy to share with you in due course. Let me begin by taking you through our numbers for FY22. The revenues for the year is at 228 crores, which is up by 3% for FY22 as compared to the corresponding previous year, FY21. Revenue was impacted due to multiple challenges at the supply chain, both at the vendor as well as our customer sites, including due to COVID delays. However, we were able to continue and maintain a healthy EBITDA margin of 24.3%. PAT at 62 crores is up by 16% on a YOY basis for FY22. I'm pleased to inform you that we have an all-time high opening order book of approximately 400 crores. Also, we have booked orders worth 25 crore since 1st April till date. We had the highest order booking of 437 crore during the last financial year, which is FY22, and highest ever opening order book gives us a great chance to scale up during the current financial year, that is FY23. Let me take you through the composition of the order book. We have diversified order mix from various industry segments, including refineries, a growing share from petrochemicals, paper and pulp, and new age industries like renewables and offshore. We also are having a highest average equipment value in the product mix, in the order mix that we have on hand. The proportion of specialty and proprietary equipment is the highest in the order book. We have added newer customers from markets like South America, Europe, and Middle East, which augurs well for the company in the years to come in future. The inquiry pipeline continues to remain robust. However, the margins are expected to be impacted due to the volatility in the metal prices which all of us are aware. On the capex front, the capex for the development of the clean room at Urhav will be completed in May. It's almost already complete, and it is commissioned. The bay is commissioned already. The clean room facility powers Anup into the elite group of global fabricators, having the necessary infrastructure for fabricating exotic materials like titanium and tantalum. It will open the doors for the new product as well as new market segments. As far as Kheda is concerned, the phase 1 construction work in Kheda is also going on in full swing and is on track for commissioning in H2FY23, sometime towards the end of Q3 and beginning of Q4. I'm also pleased to inform you that the board has recommended a final dividend that is 80%, that is rupees 8 per equity share of rupees 10 each, and the company for the year ended on March 31st, 2022. Thank you, and I shall be happy to answer questions if any.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Dixit Doshi from Whitestone Financial Advisors. Please go ahead.
Hello. Congratulations for a good performance. I have 2-3 questions. First,
sorry to interrupt you, Mr. Doshi. The audio is not clear from your line.
Is it better now?
Yes, sir.
Yeah. Thanks for the opportunity. So my first question is regarding the execution of the order book. So I assume that pre-COVID, typically we used to execute any order within 4 to 6 months. But if I see 22, it looks like it has stretched. So how do you see the execution of this 400 crore order book?
I think there is no change in the order execution cycles from the pre-COVID days to now. There is no change. The lead times for our fabrication and for all activities from the date that we receive the order continue to be in the region of about anywhere between 9 months to 12 months in most cases.
Okay, 9 to 12 months. Okay. Secondly, you mentioned that margins will remain under pressure. So in last both the years we have done around 24% plus. So how much impact do you expect?
As far as the margins are concerned, it will be we have, as you know, that we have the costs have risen very sharply in the recent months. So although we have increased our sales prices and also hedged majority of our inputs, which will help us to improve our absolute EBITDA on a yearly basis, the percentage margin will definitely see a decline. And at this moment, it will be difficult to forecast how much percentage margin at this juncture due to a very sharp volatility which continues to prevail in the input costs.
Okay, but it will be like 200, 300 basis point, or you expect that it can be even more?
I would perhaps at this stage would refrain from doing so, from making any kind of forecast on the margins at this stage, because the process still, we are still securing our materials. We are still, the process is still going on. So at this moment, it is difficult to. There are certain other, actions also which are going on. Maybe towards the end of first half, we will be in a better position to convey to you how the year is likely to end.
Okay. My next question is in terms of capex, how much we will be spending for this Uddhav capex and for phase 1 of Kheda?
Hi, I'm Bhavesh. The Uddhav capex just got completed. It will be close to around 15-18 crores. And the capex of Kheda would be in the range of 120 crores. The first phase.
The first phase. Okay. And last question from my side. You mentioned that once this Uddhav capex starts, we'll be having a much larger product basket. So it will be like different kind of heat exchangers we'll be making, or any new product we'll be doing?
Primarily, the product mix is going to continue to remain as shell and tube heat exchangers, maybe more of advanced designs, like the helical heat exchangers and end-baffle kind of heat exchangers that we have in our portfolio.
Okay, and that will go in any other industry, or it will be more or less similar like refinery, petrochemical and all?
So they definitely, will, they are going to find use across industry segments.
Okay. Okay, that's it from my side. Thanks.
Thank you. The next question is from the line of Ankit Babel from Shubhkam Ventures. Please go ahead.
Yeah, good evening, sir. Am I audible?
Yes, you are audible.
Yeah. So 2 questions. First is, what kind of order inflows you are targeting for this particular financial year? This year, FY22 was around 437 crores. So what are you targeting for this year, sir?
We are looking at, something like a growth of about 25% in this year in order booking, 25 to 30%.
Okay, great. And second, sir, you mentioned that the order execution cycle is somewhere around 9 to 12 months. So, considering the fact that your opening order book is around 400 crores, so is it fair to assume that the revenue for this year will be at least 400 crores?
Definitely. I think that's what we are looking to grow by around 30% in the next year.
Okay. And this Kheda capacity, the commissioning is expected from second half of FY23, right?
That's correct.
Okay. And sir, lastly, you did mention that it's too early to hazard a guess about the decline in margins which you are expecting. But since the orders are already there with you, you know the pricing. So, and you are also expecting, a decline in margins. So, why don't you give some guidance about the extent of the decline in margins? Can it be like 300-400 basis point, or like any typical range will be helpful for us to take an informed call, sir?
See, the thing is why I said that it is may not be the best time to look at this, because we are still trying to finalize the orders which have been received recently. That means in the month of March, whatever orders that we have received, there is still, a lot of those orders are still in the engineering stages, where the ordering is still to be done. So that may have a kind of a different being ordered now at a different time, when the prices at what levels they are going to play is difficult to tell. But I think that maybe it would be fair to assume that maybe about 3 to 4% anywhere between 3 to 4% would be an impact.
Okay, for the full year.
For the full year.
Okay. But the new orders which you would be bidding for, there again you'll be bidding at 23-24% margins.
Yes.
Thank you so much, sir.
23-24%.
Thank you.
Sorry, Ankit, the last line.
Hello,
Ankit.
Yeah, am I audible?
Yes, that last part of your what you said.
I was asking that the new orders which you would be bidding now, you would be bidding at your erstwhile 23-24% margins.
That is right.
Okay. Thank you so much, sir.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we would request you to rejoin the question queue. The next question is from the line of Gunit from Counter Cyclical PMS. Please go ahead.
Hi, thank you for giving me this opportunity. So we were talking about the capex that we are going to do. So we spoke about the capex in titanium.
Sorry to interrupt you, sir. We are not able to hear your audio clearly.
Hello, is it better now?
Yes, sir. Thank you.
Yeah, so we were discussing about the capex that we plan to do, and we are on track of completing capex for 2 facilities. One is the titanium one in May, and the phase 1 of Kheda, right? So apart from this, do we have any other pending capex? That's my first part of the question. And after the completion of the capex, how do we expect the top line to change? That's the second part of my first question.
So I would like to answer the question like this: is that we have currently the capex at Odhav is more or less completed with this clean room commissioning. And as far as Kheda is concerned, we are going to the cost of the capex is about 120 crores. Is the cost of the phase 1 of Kheda.
Right.
And the Kheda, the phase 2 and 3, they are spread over 3 to 4 years. And as far as again the the growth strategy or how the capacity is going to add to the top line, I think we are looking at a growth rate of the whole. The capex has been designed to power our growth at about 30% a year.
All right. So with the current capex,
FY23 onwards.
So with the current capex that will finish this year, how much addition to the top line can we expect by the end of this year?
So FY23 is going to be about we are looking at a growth of about 30%.
All right. Got it. I have another question. So in the June,
about anywhere between 380 to 400 crores.
All right, got it. I have another question. So in the June 2020 meeting, we had a discussion that the company has set a target to achieve 1,000 crore revenue by 2025. So is that an achievable target right now, given that we are already just 3 years away from 2025?
No, because I think it's just deferred by another 2 years. Because we lost a couple of years due to the COVID impact was quite substantial for our industry.
Right. All right. And can we expect a buyback of shares anytime soon?
Buyback.
Yeah, Guneet, we have done buyback in FY21.
February 2021.
Using our internal accrual to fund our capex. And this is only phase 1. The Kheda total capex is divided to 3 phases. So going forward, we will be utilizing our fund for our expansion.
All right. Got it. Thank you.
Thank you.
Thank you. The next question is from the line of Apurva Shah from Phillip Capital. Please go ahead.
Yes, sir. Thank you very much. Good evening, and thanks for the opportunity. So, sir, I will continue with the margin front. So, sir, I think on the margin front, since last maybe 1 or 2 interruptions, we have been guiding for some cautiously on the margins. So I just wanted to understand in whatever from that period, whatever order we have.
Clear.
Is it audible, sir? Hello?
Shah, the audio is slightly muffled. Please use the handset mode.
Hello?
Yes, sir. Please.
Yes, sir. So what, sir, I wanted to understand, from that cautious period, have we introduced any margin clause for the customers? So maybe for half year of FY22, is there any price escalation clause for the customer, and that's how we can protect the margins going forward?
No, there are no such clauses, like a price variation clause in our industry. That is not the industry practice. It's always a fixed price contract.
Okay. So that's why you are guiding for maybe 300 to 400 bips margin impact, maybe if the prices,
yes.
Raw material prices remain at the similar level, right?
That's right.
Okay. And so second thing also, I do understand that this quarterly number would not be directly comparable to the last quarter because Q4 last year was a significantly high base. But if I look at your half-yearly numbers, so this half we have done revenue of almost 148, 150 crores versus last year 162 crores. So apart from these supply chain issues and maybe some customer-related issues which you mentioned in your opening remarks, is there any other particular reasons which as an investor we should be aware, because there is a slight decrease in the half-year to half-year revenue as well?
Yeah, I think, the impact that, we had on our operations in last year, Q1, and because of the shortage of manpower and, that really hit us quite badly. In H2, we had organized ourselves better, but then that impact, which was there of wave 2 was, actually, there a lot of sites there are project sites where our equipment were headed to, they had got delayed. And also another thing that happened was, a lot of our, suppliers, they were not able to deal with that kind of a situation. And that impact really disrupted the flow of materials as required. So I think primarily these are the reasons which really, are responsible for a flattish kind of growth.
And so do you see a normalized scenario currently versus maybe last quarter?
I think, towards, if we were to look at the order flows, yes, if you see that even the order flows got restored in Q4, and we are seeing that momentum continues.
Okay, great. So last question for Bhavesh Bhai. Bhavesh Bhai, can you quantify the capex in FY22 between Odav and Kheda, and similarly for FY23, whatever capex we are guiding between these two facilities?
Pardon, come back again.
Capex.
So Bhavesh Bhai, I wanted to understand capex for FY22 between Kheda and Odav. Similarly, whatever capex we have planned for FY23 divided between these two facilities.
Yeah, so console capex for FY22 would be close to around 40 crores, and we will be spending 85 crores in next year.
Okay. So out of that 85, what would be spent on Odav and what would be spent on for Kheda facility?
Nothing in Odav. Nothing much in Odav. Odav would be hardly 2 to 3 crores, 5 crores max. All 80 crores will be spent at Kheda. Now Odav capex is more or less done.
Understood. Thank you very much and all the best for future, sir.
Thank you. Thank you.
Thank you. The next question is from the line of Prashant Kumar Hazariwala from Solitaire Financial. Please go ahead.
Hello. Good evening, sir. Yeah, good evening.
Good evening.
So my question is like what capacity utilization we are working currently?
We are working to the level of maybe about anywhere between 70 to 75%.
So still we have 25% more to go on the same capacity, and plus we will get Odav in this quarter, right?
Yes. But that's the normal level of operations that we have, because a lot of times, we have to have that kind of a flexibility, that kind of a float available in our capacity to ensure that if something goes amiss with the existing orders that we have, we can always squeeze in some orders for our traditional customers for shutdowns and replacements in these available capacities.
Right. So, but another question is, most of the orders we have received in last 6 months or 8 months, right? This current order book order portion, right? And so the metal prices have not gone much during this year. So, we something of these metal prices currently, right? So considering
a little slow, your line is not clear. The voice is kind of muffled.
Hold on. Yeah, so, hello? So is it clear now? Hello?
Yes.
Yeah, is it clear? Yeah. So my question is, most of the orders we have received in last 6 months, right? And the metal prices have not much appreciated during this period. It was appreciated before, no doubt about it, but only the fuel prices have gone up, and that impacted a lot on the inflation side, right? So why we are and currently, if you see like aluminum and all these copper prices have been softened a lot during this period, right? So how are you going for 3% of the EBITDA compression in EBITDA operating margin? That
the metal prices escalation has been the maximum in the last 6 months. It has been the maximum.
So that was done before that. Then it has gone down, and then again I can come back to the same price, right? That kind of thing has happened.
Not really. I wish that was the case.
And the growth side, like even last June, you guys are very bullish on this growth side. Like we have very good order book and all this stuff, right? Even last May or last con call, but we have not seen any growth in any aspect, like not in top line or bottom line or operating margin. So and currently you guys are saying, so what is the possibilities of this? And it's not only last year. We have seen since last 4 years, like you guys are very bullish during the starting of the year, and at the end of the year it's fizzled out, right? So this time we are running one more capacity, although, and I'm not considering the Kheda capacity. So how confirm you guys are during this time?
So last, 2 years, we have had kind of difficult years because of COVID. I think FY21 we did, we grew. But yes, you are right. In the last year, the growth has been very, very. It has been actually a flattish kind of transition into FY22, and the main reason for that is, like I have mentioned earlier in the call, the impact on the supply chain. That was something which was quite underestimated by us when we talked about in the last con call, which and also the impact of this, on the customer sites, the delays that happen at the customer sites, the project sites, which were not ready to accept the equipment. So I think those kind of delays were not really expected and not estimated. The other thing, if you were to look at, which is different in this year, how it makes it different, is that never before have we opened the order book at this number, at such a high order book. Last year, I think it was somewhere about 256 crore. This year, we have opened at 300 and something like around 400 crores. And subsequently, also we have booked orders, and that the order flows will looks to continue going forward as well. So that gives us a full year to plan our kind of equipment, the engineering, procurement, and ensure that the material and all, whatever inputs are required for the fabrication of our equipment are all available on time. I think that's one key element that is required. Also, if you were to look at the last few years, we have been looking to, because of the order book was lower, we were looking to deliver ahead of schedule, and sometimes in our industry that doesn't really hold good. Whereas this time we have orders where the deliveries are going to happen are required in this financial year in FY23. So that is going to be the difference in this year.
Thank you.
Thank you.
Mr. Azariwala, may we request that you return to the question queue for follow-up questions. The next question is from the line of Abhilash Mendeti, individual investor. Please go ahead.
Yeah, good evening to one and all. My query is regarding the KEDA capex. How much the total capex will be incurred in KEDA? Is it 120 crore or is it more than that?
The total capex of KEDA for all phases put together is close to around 275 crores. In the first phase, which we have already started, we will be incurring 120 crores.
Okay. And why isn't the company exploring the pharma sector as a clientele in the clientele list? Or let it be like this, or any chances of precision equipment and further into?
Yeah, so we are there.
Diversification?
Yeah.
Yes. There is diversification is definitely very much high on our agenda. And if you were to look at the current order mix also, there is the proportion is growing in the petrochemicals. We have in the past years also already made breakthroughs in the power segment, and we are continuing to do so in the current year as well. So and even precision equipment, the likes which are required for nuclear, aerospace, and defense is something that is going to come up as KEDA, as we come towards the completion of the third phase of KEDA.
Okay. The Udav expansion which we are doing, is it? Can it give a chance of exploring a higher order book, like bigger orders from bigger players, because of the clean room technology?
Definitely. The clean room technology, the whole development of this bay and this facility is to get into a higher order, kind of a segment.
Okay. Thank you. That's it from my side. Thank you.
Thank you. The next question is from the line of Kunal Shah from Carnelian Asset Management. Please go ahead.
Hi, thank you for the opportunity. I have just one question. So we were having a bottleneck of the capacity, which I believe now should be done through, since we are done with the capex at Udav, the Bay, that is the Bay Area, right? And so what I'm trying to understand is that even if KEDA doesn't come up, say by what is the revenue potential that one can go through from this existing facility now?
From the existing facility, the revenue potential for the next year you want to know?
No, next year you've already said that we'll be doing the execution of the current order book, right? So the capacity constraints.
The revenue potential from the current facility, which is at Odhav, we can double it. The potential is to double it.
So from existing facility, we can easily go up to 600 crore kind of top line is what we are saying. And now with this Bay Area coming up?
Yes, all the capex at Odhav is now complete, and we can increase the turnover from this facility itself to about 600 crores.
Okay. And sorry, yeah, please go ahead.
Yes, between 500 to 600 crores.
Okay. And just wanting to understand, we have got a good uptick in the order book from 283 odd crores to the present where we are. But as one of the participants said, the execution basically is a little slow in comparison to what we did in the last half. So is it partly because of the slow execution that we are seeing the traction in the closing order book, or how should one read that? Because if you see the Q3 and Q4 of last year and we see Q3 and Q4 of this particular year, right, then the execution probably has slowed down in comparison to the last year.
It's like I said, I think the delays that happen at the site, if you look at the execution speed, I think one indicator of that is our on-time deliveries record. It continues to remain very intact. So whatever orders we are taking, we are delivering almost, quite either on time or ahead of schedule. There is no slowdown there.
Okay.
Yes, to the reasons that I have already stated in the call, because supply chain disruptions and the site delays, and that really was kind of underestimated by us, I would say so.
Okay. And how are you seeing the traction now building up? Are you seeing any green shoots in the capex other than crude? Obviously, is doing very good, so there it's visible in the order book as well. But what's your sense now with the cost escalations that have happened? Right, we see a lot of companies postponing their capex plan because of the budget going haywire. And there's a sudden slowdown, as far as the order booking goes for the capex. So, what's your sense on how is this going on presently?
So, how we are looking at it is that currently, I think the refining capacities and petrochemical capacities in India, they are likely to continue to have these, the capex in the next maybe 3 to 5 years. That is likely to continue, and that is already going on, and we are seeing what is happening. I think that traction continues. However, we are looking to now focus on the global market as such and start growing our exports. I think that's one area where we have taken the focus is going on, and areas like we have already made beginnings in projects of where blue hydrogen projects for certain in fact the first project of its kind. We are getting into chemicals. We are getting into different sectors like fertilizers, gases, geopower, green hydrogen, and green ammonia. So these are the areas where we are going to diversify, and there are definitely opportunities available to us at the global level, most certainly. And in the existing sectors also, there are companies who are going to, apart from India, who will ramp up the refining capacities and the petrochemical capacities, and those capex are continuing. So that is very much evident in the kind of inquiries that we are getting.
Okay. So basically, you're not seeing that much of a challenge as far as the capex inquiries goes. Yes, the costs have gone up, but still the inquiries continue to be robust, basically.
Yes, I think I would place the main reason for that is that we are into the high-end engineering kind of an equipment. These equipment are key to a plant's operation. So I think these equipment are definitely something which where we are not seeing those any kind of a decline there.
Okay. And just one question, we are, focusing very much on exports. So since the transportation cost of our capital goods equipment plays a very important role since they are bulky, right? So how does the competitiveness get affected, if at all it gets impacted, when we are transporting or making it for a client which is based out of India?
So we have, exported in the past as well to all parts of the globe, including, the United States and Canada and South America. Apparently, what is happening is that these kind of engineered equipment, the capabilities to engineer, the capabilities to design are, our strength here in India, and also the manufacturing. The whole manufacturing technology for these kind of engineered equipment is our strength. And that's the reason why we are seeing that the kind of capabilities that we have, those companies are, in the developed part of the world, they are either, they have already shut shop because they are not able to compete. This being a very, very, material and labor-intensive kind of work, Engineering efforts are so intense in this that, in fact, most of these companies, they have their procurement and engineering centers located here in India.
Okay. No more from the perspective that is the competition or industry size small for us to focus on India, or because in the past you said that margins when it comes to exports and domestic are more or less similar, right? So more from that perspective as well. Is the competitive intensity in India increasing and therefore focus on exports? Or how should one look at that?
The kind of players who are approved for these kind of products that we are making, you can count them on your fingertips. It's a very, very small field. These are highly critical, highly complex, and the degree of engineering which goes into these equipment is quite high. We have very few there, and I think that is the competitive landscape is very favorable for us.
Sure, sir. Thank you for answering all the questions. Wishing you all the very best.
Thank you. The next question is from the line of Aman Vij from Astute Investment Management. Please go ahead.
Yeah. Good evening, sir. My first set of questions is on this specialty/proprietary equipment which you have talked about. If you can explain what is the order book of such products this year? What was the revenue, say, of such products in FY22, as well as if you can talk about is this only helical heat exchanger you are talking about, or what all is considered as proprietary or specialty products?
You are talking about from the revenue mix point of view?
Yes. For FY22, as well as you have mentioned, in the order book, it is one of the highest proportions. So if you can talk about that also.
So in the order book, it is to the tune of maybe to the extent of about 45%.
Okay.
And as far as the revenue mix is concerned, maybe we'll have to fetch that data. But it would be, I think, to the tune of about 15 to 20%.
Yeah. So correct me if I'm wrong. First, if you can talk about what all products are included in this specialty or proprietary equipment.
Sir, advanced designs of heat exchangers, I would, I've already named the helical, and there are several other designs like these. So I would refrain from naming the other designs.
Sure, sir. But in terms of growth, of say 300 crore sales, which we did, you were talking about 15-20%, which is like 50-60 crore. But of 400 crore, you were talking about around 150 to 200 crore order book. So is there such a substantial jump, or is my understanding?
That's right. I mean, the whole idea is that these equipment give a clear advantage to the user in terms of efficiencies and in terms of savings. So that's the reason why most users are now switching over to these advanced designs.
Sure, sir. That makes sense. So, these advanced designs were the new CapEx which we had done at Odhav. Is that helping in getting this, or what is
I think the demand for such products is increasing. It's, one thing is that, the kind of experience that we had in these, kind of advanced design for the last 12 years. And the second thing is that, more users are becoming aware about it. So they are preferring to go in and for these designs rather than going for a standard, kind of a heat exchanger.
Thank you, Mr. Vij. May we request that you return to the question queue for follow-up questions. Ladies and gentlemen, that was the last question for today. I now hand the conference over to Mr. Rishi Roop Kapoor for closing comments.
Thank you, everyone, and we'll be happy to connect with you during this year. Thank you.
Thank you. Ladies and gentlemen, on behalf of the Anup Engineering Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.